So I died when I saw this meme pop up on my Twitter page. So is value investing dead? I think that's not the main discussion point in today's video. I'm just going to explore a few big tech earnings recently and just provide you with a very quick opinion, specifically to those that I actually own, namely I think Google and Meta. So without knowing it, I think based on how I construct my portfolio and my own investment criteria, I'm slowly turning into a dividend investor. First, Alibaba announced a dividend. Next, Meta announced a dividend. And right now, even Alphabet, which is the parent company of Google, also started announcing a dividend. So I think to bring home the point, in any corporate finance class, you know that business also have its own life cycle. And like us human beings, at different life stages, it requires us a different level of commitment. And at least in this case, for many of these big tech companies, they are huge money-making machine, and they've probably already grown to a size where it's really hard to move the needle, which is why most of them, if not I would foresee all of them starting to pay a good amount of dividends and basically reward shareholder in this case, because there's really very limited investment opportunity elsewhere for them to get a good rate of return. So the bottom line to me is relatively simple. As long as it's a money-making machine, I don't really care whether is it a young company or an old company. But that said, the caveat here is they have to be deploying capital effectively, and it has to be net accrual to shareholder value. So I'm just going to provide you with a very brief overview of both Google and Meta's earnings, and maybe I might talk about Tesla depending on the length of this video. And in this video, I wouldn't be breaking down the nitty-gritty, telling you that they grew from X billion to X billion, because it doesn't really make sense if you don't really have contextual understanding. But more so, I'm just going to give you some high-level picture and my perspective on their recent earnings. But for those of you who fancy this kind of detailed breakdown, line by line, maybe you want to leave in the comment section below. If there's enough interest, maybe I will do another one. But that said, I will leave the link to maybe 2 other videos, specifically 2 on Meta and 2 on Google, from other YouTubers that I think had done a pretty good job about it. So focusing on to Meta, I think the year of efficiency has produced spectacular and marvelous results. It was a huge comeback from their 2021-2022 debacle and slow down and crazy amount of investments that doesn't lead to growth. So the numbers are amazing for this recent quarter. Long story short, I think the main concern was that they wanted to continue investing aggressively into their AI infrastructure, and they did say that they're dialing up their expenses guidance, 30 to 37 billion to 35 to 40 billion. So you can see at the top line, they actually increased their capex expenditure guidance for around $3 billion. And they did float that, hey, this is a multi-year investment cycle. So this is just the start. It's not the end of them spending lesser money. And for those of you who sat through the same cycle, there might be some sort of PTSD back in 2021 and 2022 when they said that they're going to go all out and spend a lot of money for the metaverse. But to be very frank, I think this time around it's slightly different. I think not all investments made are the same, but at least in this case, I believe that the capital that is allocated to the AI investment would yield much greater return compared to the metaverse. And of course, on a side note, the metaverse is still burning a crazy amount of money and it's not profitable. At least it's robbing away a lot of the cash flow that Meta is producing. But I guess it comes as a package. If you're interested in investing into Meta, you need to accept and embrace the ugly side of it. Recently, many investors are on the lookout for higher yield on their idle cash. So you are in luck. Right now, Moneybull, which is a wealth management tool offered by Webull, can help you earn a yield by investing your idle cash into the underlying cash fund. So based on the latest 7-day yield of the USD cash fund, as of 25th of March 2024, it has delivered around a 5.4% USD per annum. So we wouldn't know how long more this would last, which is why you might want to act soon and squeeze it as much as you can. So for new users, you can also take advantage of the sign up promo by subscribing to at least $2,000 to Moneybull and maintain until the 31st of May 2024. You can get 20 Nvidia shares worth between $10 to $500 each. So Webull has been an amazing partner for my investment journey, and I can't wait to see you guys there. All the details to their campaigns will be in the link down below. Thank you Webull for sponsoring this video. Now moving on to Google, a very simple summary, I think from Joseph Carlson, it's very apt. Oh, you doubt me because we goofed a few demos? Well, let me just increase margins like crazy, grow cloud like crazy, freeze hiring new employees, issue a dividend, and pull this massive buyback lever. Essentially, this was a stellar quarter for Google. Everything is trending in the right direction. They basically also squashed many of the concerns around ChatGPT eating their lunch, Google advertising not being on par with many of their competitors, and them basically losing the search market. So fun fact, Google search actually outpaced the family of apps and YouTube ads over the last 3-year period. So as a Google shareholder, nothing much to ask for. Everything is growing in line and even exceeding expectations. So the third company on this list, which is Tesla, I think for Tesla specifically, it's a controversial topic, but sitting through the earnings call, I think there were two best responses that essentially sent the stock up to the moon. So it was from Elon Musk when he answered the question around the $25,000 vehicle. And he replied, "We'll talk about this more on August 8th. So the way to think about Tesla is almost entirely in terms of solving autonomy and to turn on autonomy for a gigantic fleet. And I think it might be the biggest asset value appreciation in history when that day happens. That if you value Tesla as just an auto company, fundamentally, it's just the wrong framework. If you ask the wrong question, then the right answer is impossible. So I mean, if somebody doesn't believe Tesla is going to be able to solve autonomy, I think they should not be an investor in this company," unquote. So right now, for an investor like myself, I'm in a very precarious and tricky position. I would really like to believe in the mission and vision of Tesla and that they are the one that solve autonomy, but I'm really not in that space, or I don't have that confidence interval to tell you that yes, I do believe that Tesla is able to solve it easily. So here's the thing, I think when I cross-check with some of the other investors, I'm talking about Tesla's car business, and it just value it solely as a car company, the overwhelming consensus was that the valuation is probably nearer to $60 to $90 per share. So really the additional incremental valuation that you are paying today is the optionality of Tesla FSD, robotics, Optimus, and energy storage, etc, etc. So it's really dependent on how you want to pull the lever and to understand or to really determine what is the potential of Tesla and then put your money where your mouth is at. So for myself right now, I'm still doubtful, which is why I probably haven't started a position in Tesla, and I don't think that the margin of safety, or at least in this case, what if I'm wrong, the premium is, or at least the discount is not large enough. That's why I haven't entered. So that's just my own personal perception and perspective about it. And I would like to just say that Tesla or Elon Musk, they are still joined by the hip. Elon Musk is still like the biggest and the best salesman for Tesla. And Elon Musk can just go onto an earnings call and paint a beautiful picture for investors. And a lot of investors are willing to buy into this idea, which is why you can see that it's reflected in the stock price itself. But the funny thing is, if you just judge Tesla based on the numbers that they just produced, it was a pretty ugly picture. So margins are coming down, they're investing heavily in capex, free cash flow basically is going to evaporate. Revenue growth, everything is going down. So going back to the meme that is posted at the start of this video, why did Meta came in with strong numbers but the stock price tanked, and Tesla came in with weak numbers and the stock price increased? And I would just like to cite what Howard Marks has to say in his memo from 2015 with the title, "It's Not Easy." And I quote, "The bottom line is that first-level thinkers see what's on the surface, react to it simplistically, and buy or sell on the basis of their reactions. They don't understand their setting as a marketplace where asset prices actually reflect and depend on the expectations of the participants. So they ignore the part that others play in how price changes, and they fail to understand the implications of all these for the route to success." So long story short, I think it's just a difference and mismatch between expectations versus reality. So that's the two parables of the Magnificent Seven. So I think the bigger question for most investors, personally for me, because I also have a huge exposure in Chinese equities, is that how about Alibaba? It's still so weak, it's not producing any results, the stock price is still basically flatlining, so is Tencent. So I think for myself, I have always been promoting or being consistent with my tone, saying that we should persevere. It's still a tough times ahead. I don't know when is the bottom, but I do think that the risk-reward opportunity here is quite spectacular. And I've been talking to my friend about it, and one of my friends actually did text me saying that, "Oh, you've been saying it for 3 years." But I think in the grander scheme of things, we have to understand that investing is a pretty long-term game. Even 3 years is quite a short time horizon. For myself, I really look at this China equities hitting rock bottom level. So the sentiment is pretty devastating. So I don't know for sure whether the Chinese market is going to undergo something like the Japanese market. But what I do know for sure is that your margin of safety is extremely huge at current levels. So I just focus more on not trying to lose money rather than trying to chase for the highest return in this case. And I think if you hold long enough, you probably wouldn't come out too badly. And also, if you look at many of these Chinese stocks, they recently started buying back shares much more aggressively, started issuing out dividends as a new policy, and that's how they kind of take care of shareholders in a way. And if you have been observing, the Hong Kong side has been rallying quite hard over the last week, and they're set to outperform the US by the most in the last 18 months or so. So I do think that the Hong Kong market has bottomed. So I've probably called the bottom for the third time now. So the first time back then was during the re-election. It was rock bottom pessimism. So that was right. The second time was when I see a switch in terms of the tonality from the government. And I was wrong for the second time because from that video, the share price actually went down quite a bit more. But I think that throughout this whole period, at least over the last 6 months or so, I think it is a bottoming out period. I don't think we are seeing another level of sell down, but that's just my own opinion, so take it with a pinch of salt. So Amazon is the last company in the Max 7 that I have in my portfolio, so I'll update you guys again next week after Amazon report their earnings. I'll see you guys in the next video, but more importantly and hopefully in 2024, I'll see you guys on the moon. Goodbye!